TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
Hello, TSS traders. We've prepared a summary of the past week for you. Welcome to the deep dive.
Yeah, thanks for having me. I mean, what a week to unpack, right?
Absolutely. We are looking at a genuinely chaotic, just a paradigm-shifting 5 days of market action. We're tracking the tape from Monday, March 2nd, straight through the closing bell on Friday, March 6th, 2026.
It was definitely one of those weeks that forces a total recalibration of your whole model.
Yeah.
Anyone who came into Monday relying on the structural assumptions that dominated, the last quarter of 2025 and early 2026, they likely got their face ripped off.
Completely.
The regime changed, and it changed violently.
And to figure out exactly how and why that regime change happened, we were pulling from a really phenomenal stack of source material today.
The SpotGamma notes.
Exactly. We've got the complete daily AM and PM quantitative notes from SpotGamma for the entire week. And for anyone tracking the tape, these notes are just essential reading.
They really are. They look under the hood.
Right. They are meticulously mapping the S&P 500, the VIX, and most importantly, the underlying options flows, which, let's be honest, are the actual tail wagging the dog in modern equity markets.
That is the critical distinction right there, because if you were just reading the fundamental headlines this week, the jobs numbers, the ISM data, the geopolitical wires, you were essentially trading blind.
You were just guessing.
Exactly. The SpotGamma notes cut through that narrative, and they look at the mechanical plumbing. They show us where the massive institutional money is parked, how those funds are hedging, and precisely how those hedges force market makers into mandatory price-agnostic buying and selling.
So our mission today is to decode that specific machinery. We're going to look at the gamma positioning, the put walls, the volatility triggers, and really unpack how an escalating geopolitical shock literally snapped the stock market out of a trading range that had trapped it for months.
Yeah, we have to understand why the dealer positioning matters so much when the macro backdrop suddenly flips on its head.
Okay, let's unpack this. Why does it matter so much? Give us the 30,000-foot view.
Well, it comes down to liquidity provision and forced positioning. We have to remember that market makers, the dealers taking the other side of these massive institutional option trades, they do not want directional risk.
Right. They just want to make the spread.
Exactly. They want to collect the spread and stay delta neutral. But when you get a macro shock that violently reprices massive blocks of options, those dealers are suddenly thrown off sides.
The delta exposure just explodes.
It explodes. So to get back to neutral, they are forced to buy or sell the underlying futures or the index ETFs. When the market is in a certain structural profile, that dealer hedging can actually suppress volatility and keep the market pinned. But when you cross key thresholds, which we absolutely did this past week, that forced hedging acts like a massive accelerant.
It just pours gas on the fire.
Right. It creates brutal mechanical squeezes or cascading sell-offs, regardless of what a company's fundamental earnings actually look like.
Okay, so let's ground this in the actual levels we were dealing with coming into the week. Heading into March, the SPX had been stuck in this incredibly stubborn consolidation pattern since Thanksgiving of 2025.
The Thanksgiving box.
The Thanksgiving box. SpotGamma accurately mapped this as a literal box between 6,800 on the downside and 7,000 on the upside, which is a suffocatingly tight range for an index of that size over a 3-month period.
Right. And it wasn't a coincidence. It wasn't just traders lacking conviction. It was a direct manifestation of the options market structure.
Because of the walls.
Exactly. The notes highlight that the 7,100 level, and more specifically the 7,000 level, which held the absolute gamma strike, was acting as an immovable call wall.
So break that down. What does an immovable call wall actually mean for the dealer?
You had a massive concentration of institutional call options sold up there. As the market naturally drifted upward toward 7,000, dealers who were short those calls found themselves getting increasingly short delta. To hedge that risk, they had to sell the underlying index. That forced selling created an artificial ceiling. Every single time we tested the highs, the dealers naturally capped it by selling.
And then on the bottom end of the box, we had the exact opposite happening at the 6,800 put wall. I mean, every time the market rolled over the last 3 months, it had hit 6,800 and magically find a bid.
Because of the exact inverse mechanics. At 6,800, you had this mountain of put options.
Yeah.
As the market dipped toward that strike, dealers who had sold those puts to institutions became increasingly long delta.
So to flatten out, they have to buy.
They are forced to buy the underlying index. So you had dealers mechanically selling the rips at 7,000 and buying the dips at 6,800. For months, the SPX was just oscillating in that dealer-constructed pinball machine.
But coming into this past weekend, the pinball machine got tilted.
Big time.
We got the catalyst. The weekend wires lit up with headlines about a broadening geopolitical conflict involving Iran. And just to state this clearly for you listening, our goal here is to analyze the market mechanics, not the politics.
Right, we are just looking at the math.
Strictly looking at how the algorithms, the institutions, and the options flows price the risk of those headlines.
Right.
We don't take sides on the geopolitics. We are looking at the math.
And the math is brutally objective. When a geopolitical shock of this magnitude hits, especially one centered in the Middle East, the equity market doesn't immediately know how to price the earnings impact on the S&P 500. It's too abstract.
So what does it look for?
It looks for a more direct proxy to price the risk. The SpotGamma notes make it very clear that the ultimate early tell for this specific flavor of risk is the energy sector. Oil becomes the real-time ticker for the conflict.
And the move in oil this week was nothing short of staggering. West Texas Intermediate crude didn't just pop on the open. I mean, it ripped. We saw a massive 6% gap up right out of the gate on Monday morning.
Huge move.
And it never really looked back. It just grinded higher all week to close up a massive 21% at $85 a barrel. So why is the options market so hyper-focused on that specific $85 print? And how does that translate into what the notes call a quote-unquote conflict premium?
It's the secondary and tertiary effects that matter to equities. Think about it. A 21% spike in crude oil over 5 trading days. That is a violent inflationary shock.
Oh, yeah.
It's an immediate, unlegislated tax on the consumer. And it shreds the forward margin guidance for corporations across almost every sector. But from a volatility perspective, the conflict premium is really about uncertainty.
How so?
If a geopolitical event is a one-off isolated strike, the market can price it, digest it, and move on.
The algos just process it.
Right. But a broadening conflict introduces unknown variables that might extend for months. So volatility sellers, the funds that usually supply the market with cheap options, they completely step back.
They close up shop.
Exactly. They refuse to sell downside protection cheaply because they have no idea what the weekend headlines will look like. They demand a massive premium to take on that risk. So, as oil marches steadily higher, it concerns that the situation is escalating, which forces equity volatility to stay heavily bid. The notes explicitly summarize the dynamic higher oil, in the short term, screams higher volume.
Now, while everyone on financial television was staring at oil and the Middle East, the Tuesday AM note flagged something buried in the underlying tape that I found incredibly alarming.
The BIZD ETF.
Yes. They pointed out the price action in the BIZD ETF. For context for you listening, BIZD is a basket of business development companies. These are the entities providing vital middle market lending.
Super important sector.
And the note highlighted that this ETF was breaking down and testing its April 2025 lows. The author specifically added the context that April 25 was not a good look for the global financial system.
And this right here is exactly why you read these quantitative notes. It's a brilliant catch.
It really is.
Because the retail crowd and the algorithmic news scrapers are all trading the World War III headlines, but creeping credit stress is the actual systemic killer.
Yeah.
Middle market companies are the engine of the economy, and they are highly sensitive to borrowing costs and liquidity. If the BIZD ETF is plunging back to crisis-era lows, it means the bond market and the credit default swap market are sniffing out severe stress, or at least a sharp contraction in lending.
Because geopolitics cause acute initial shocks. But historically, it's the underlying credit problems. You know, when the plumbing of the lending market freezes that actually trigger those sustained multi-month VIX spikes.
Exactly. The fact that this credit proxy was failing simultaneously with an oil shock was a massive red flag. It suggested the structural foundation of the market was cracking entirely independently of the Middle East headlines.
Which brings us to the gamma environment itself. If credit is cracking and oil is surging, that 6,800 put wall floor we talked about is going to be tested in a way it hasn't been in months. According to the notes, what actually lives below 6,800?
A completely different universe.
Dark matter.
Basically, yeah. Below 6,800, the SPX enters an environment heavily dominated by negative gamma. And it's not just a slight transition. The notes map out that the negative gamma profile continues to deepen and doesn't actually max out until you get all the way down into the 6,600s.
Let's break down exactly what that means for a TSS trader watching the tape. Because it really dictates the entire behavioral profile of the market, right?
Totally.
In a positive gamma environment, which is where we've been living during that long consolidation, dealers are providing liquidity. As the market drops, they buy. As it rises, they sell. It dampens everything. It suppresses realized volatility. It's like a shock absorber.
That's a great analogy. Positive gamma forces mean reversion, but negative gamma forces trend continuation and an expansion of volatility. It's like driving on black ice.
I like that. Black ice.
Because when the market drops below 6-800, dealers are now short gamma. This means as the market falls, their delta becomes longer, forcing them to sell the underlying index to get back to neutral.
So they are chasing the market down.
Right. So the market drops, dealers are forced to sell, which pushes the market lower, which forces dealers to sell even more. Conversely, if there's a sharp rip upward, dealers suddenly have to buy to cover. They are no longer providing liquidity, they are aggressively taking it.
The order book just thins out.
It vanishes, and price action becomes incredibly slippery, violent, and untrustworthy. You are essentially dealing with an order flow profile where every single directional move is amplified by algorithmic forced hedging.
And the notes warned that because of this structural profile, the positioning was ripe for a very quick slip into the 6600s if that 6800 floor broke, simply because there were no major dealer support zones to act as a buffer.
It was an air pocket.
Which perfectly sets the stage for Monday and Tuesday, a period the notes aptly categorized as the don't be a hero phase. Let's look at Monday morning, March 2nd. The initial shock hits the tape. SPX futures are down anywhere from 90 to 175 basis points in the pre-market. We immediately gap down and test that 6800 risk pivot. And the AM note comes out with a very blunt directive. Quote, don't try and be a hero.
It was a very necessary warning against muscle memory.
Yeah, people get used to the box.
Exactly. For 3 solid months, any trader who blindly bought the 6,800 dip was rewarded. It was easy money. But the context had completely shifted over the weekend. The conflict premium was now a real driving factor.
And that negative gamma trapdoor was wide open, right beneath 6,800.
Wide open. Buying that dip might have felt familiar to a lot of traders, but statistically, the risk-reward was suddenly incredibly asymmetric to the downside. The structural integrity of the market was compromised.
But if you just looked at the closing print on Monday, you might have thought that warning was overly dramatic. I mean, the market actually bounced.
It did.
It tested the 6,800 put wall, found a bid, and managed to close slightly green on the day at 6,882. For a retail trader glancing at a daily chart on Yahoo Finance, it looked like the ultimate validation. The floor held, the dip buyers won again.
What's fascinating here is the actual reason for that bounce, and that is the danger of trading price without understanding flow. The PM note on Monday just ripped the mask off that rally.
Yes, the IRO data.
Right, they broke down the IRO data.
Yeah.
The hedging implied volatility flow, which is arguably the most important metric SpotGamma provides because it tracks the real-time directional options delta impacting the tape. The IRO data revealed that this was absolutely not organic buying.
So what was it?
Traders were aggressively selling puts. Specifically, the data showed about $1 billion in longer-dated puts being sold, alongside about $2 billion in 0 days to expiration calls being sold.
Okay, I want to spend a minute on this because a lot of people see put selling and they immediately assume it's a bullish signal. They think, oh, people are selling puts, they must think the market is going up. But reading the breakdown, that's a total misinterpretation of the flow, isn't it?
It is a complete misinterpretation. Context is everything. When you have a massive pre-market gap down driven by weekend geopolitical fears, the puts that institutional managers bought on Thursday or Friday to protect their portfolios suddenly explode in value.
Right.
When the market opens, those managers want to lock in those massive gains. So they sell the puts back to the market to monetize the hedge. They are cashing in their lottery tickets.
Taking the profit on the insurance policy.
Exactly. Now, think about the dealer on the other side. When the institution originally bought that put, the dealer got short delta and had to short the S&P 500 to hedge. But on Monday morning, when the institution sells that put back to close the position, the dealer's short delta vanishes.
Right, the risk is gone.
So the dealer no longer needs that short SPX hedge. So what do? They aggressively buy the index back to flatten out.
So the entirety of Monday's quote-unquote rally was literally just dealers mechanically buying back their short hedges because institutions were taking profits on their downside protection.
Precisely. It was a mechanical unwinding of fear. It was not an injection of fundamental confidence. There was no real money stepping in and saying, hey, at 6,800, these tech multiples are a screaming buy for the next decade.
It was just transactional plumbing.
That's all it was, transactional plumbing.
And for a TSS trader, recognizing that distinction is the difference between making money and getting trapped. A fundamental rally has sustained demand. A mechanical rally, driven by put covering, is hollow. Because once the managers are done monetizing their hedges, the dealer buying immediately shuts off. There is no bid left underneath the market.
Furthermore, the PM note pointed out a glaring red flag. Despite the SPX bouncing and closing green, fixed strike vol closed higher on the day.
Which is huge.
It's crucial. It means that while some managers were cashing out their specific put positions, the broader options market was simultaneously bidding up the cost of new downside protection across the board. The underlying baseline of fear was actually rising while the market price was bouncing. That is the definition of an unstable divergent tape.
And we saw the consequences of that rising fear manifest violently in Tuesday's action. Tuesday, March 3rd, was really defined by a massive, undeniable flight to safety across multiple asset classes.
Yeah, it was a rush for the exits.
The U.S. dollar index surged 1.5% in a matter of days, which is a massive move for the DXY. Gold and silver were catching aggressive bids, and SpotGamma notes highlighted that safe haven proxies, things like the IEF and TLT for treasuries, and UUP for the dollar, were seeing overwhelming call demand over puts. The smart money was quietly rushing to the lifeboats.
They were positioning for a liquidity crunch and a growth shock. And yet, if you look at the headline SPX index on Tuesday, it managed to close up 0.94% at 6,817.
It's crazy.
Call buying actually started to temporarily replace put selling in the very short-dated flows. But the quants at SpotGamma were explicitly fading this strength.
Because they were looking under the hood again. The notes highlighted a severe structural divergence. The headline S&P 500 was being buoyed by a few heavyweights, but the QQQ, representing the NASDAQ 100, and the IWM, representing the Russell 2000 small caps, were acting incredibly weak.
It was a textbook stealth distribution pattern. The SPX was green, but both the QQQ and the IWM were trapped squarely below their respective vol trigger levels.
Let's define the vol trigger for the listener quickly, because it's such a critical concept in these notes.
Sure. The vol trigger is the mathematical line in the sand where the aggregate dealer positioning flips from positive gamma to negative gamma.
Okay.
When an index is above its goal trigger, dealers are suppressing volatility. When it drops below, dealers are amplifying volatility. So while the SPX was clinging to this 6,800 put wall and pretending everything was fine, the heavily weighted tech sector and the economically sensitive small cap sector were already submerged in negative gamma territory.
The notes referred to this as the market's soft underbelly being fully exposed.
Yeah, the engines of the bull market were already broken. The fuselage just hadn't realized it yet.
That sets up a wildly complex psychological dynamic for Wednesday. If Monday and Tuesday were about recognizing fake strength, Wednesday, March 4th was an absolute masterclass in market mirages.
Oh, Wednesday was wild.
We get the ISM services data dropping, which came in a bit softer than expected, giving some hope that maybe the Fed has room to maneuver. At the same time, Bitcoin suddenly catches a massive bid, surging past $73,000. And the SPX just melts up. It blasts off from the low 6,800s and closes near the highs at 6,870. The financial media is instantly declaring the all clear. The bulls are back in charge.
And this is the exact moment where quantitative options data separates the professionals from the gamblers. How do you distinguish a genuine, fundamentally driven breakout from a toxic mechanical trap?
You look at the AM note.
Exactly. The AM note on Wednesday provided the smoking gun. They brought in a metric called the SDEX, which measures skew.
Right, the SpotGamma skew index. Let's break down exactly what that's measuring before we talk about the reading, because the reading was historically extreme.
Skew, in this context, measures the relative cost of out-of-the-money put options compared to at-the-money options. Specifically, the SDEX looks at a 1-month out-of-the-money SPY put. When skew is steep, it means traders are willing to pay a massive premium for downside tail risk protection relative to standard daily variance.
So they are extremely nervous.
Very nervous.
Yeah.
On Wednesday morning, the notes flagged that the SDX had spiked to pre-2024 levels. It was sitting at the 95th percentile.
The 95th percentile. So heading into this perceived quote-unquote breakout, downside protection was historically as expensive as it gets. The market was absolutely stuffed to the gills with protective puts.
Stuffed. The street was maximally hedged for a crash. And ironically, that extreme defensive positioning provided the exact mechanical fuel required for Wednesday's squeeze.
How does that work?
The PM note detailed the chain reaction perfectly. You have a market overwhelmingly loaded with puts. When the spot price of the index managed to drift even slightly higher, maybe off the ISM print or the crypto bid or just random noise, the Greeks on those massive put positions started to shift.
Let's track the math on that for you listening. If the market drifts higher, the out-of-the-money puts that everyone bought start moving further out of the money.
Right, and as they move further away from the current price, their delta and gamma begin to bleed out. They lose their sensitivity to the index price.
Okay.
Now, put yourself in the shoes of the market maker who sold all those puts to the institutions. Because you are short puts, you have positive delta. To hedge your book and stay neutral, you had to aggressively short the S&P 500 futures.
But now, as the market creeps up and those puts lose their delta, your hedge profile changes.
Yes. Your short stock position is suddenly too large relative to the declining risk of the puts you sold. You are overhedged on the short side.
So you have to buy.
To rebalance your book, you have absolutely no choice but to buy back those short hedges. You have to buy the underlying index.
And because the SDX was at the 95th percentile, the sheer volume of puts in the system meant there was an enormous amount of short delta that needed to be covered.
It was a massive short squeeze, but it was purely structural. Market makers buying back their hedges pushes the spot price higher. The higher price causes even more puts to bleed out their delta, which forces even more short covering by the dealers.
It's a loop.
It's a self-fulfilling, entirely mechanical melt-up. The SpotGamma PM note explicitly cited this, stating that the short cover rally provided consistent bids to the market and supported the melt-up we observe today. It wasn't institutional accumulation of equities, it was just a mathematical rebalancing of hedges.
Connecting this directly to you, the listener, and your trading strategy. Understanding dealer put delta bleed is not just academic trivia. It dictates how you manage risk.
Completely.
If Wednesday was a fundamental rally based on great economic data, you want to buy the breakout, size up, and ride the momentum. But if you are reading the SpotGamma notes, looking at the 95th percentile SDEX, and realizing that this is just a mechanical squeeze occurring within a broader negative gamma regime, your strategy completely inverse.
You fade it.
You do not trust the breakout. You fade the rip. You use that mechanically inflated price to enter short positions or buy cheaper downside protection, knowing that the structural bid will vanish the moment the dealer hedging is complete.
That is the essence of trading negative gamma environments. Mechanical squeezes exhaust themselves. The moment the dealers are flat, the bid disappears. And in an environment dominated by $85 oil, a broadening war, and cracking credit markets, an exhausted mechanical squeeze leaves the market incredibly vulnerable.
It's the Wile E. Coyote moment.
Exactly, running off the cliff and hovering in midair before looking down.
And Thursday, March 5th, was the moment the market looked down. The Wednesday mirage evaporated instantly. Oil continued its relentless march, gaining another 5% to push deeper into the 80s. The SPX reversed all of Wednesday's mechanical gains, dropping back down to 6,831.
It was brutal.
But what was truly terrifying about Thursday wasn't just the directional move. It was how the market moved. Here's where it gets really interesting.
It was predatory. The environment was perfectly primed. The mechanical squeeze had cleared out the weak shorts. The dealer bid was exhausted. And the market was left drifting in a liquidity vacuum, still facing the absolute realities of the macro backdrop.
The Thursday PM note flagged something in the tape that genuinely reads like a financial thriller. They isolated a specific, highly aggressive algorithmic flow that they literally dubbed the seek and destroy algo. Tell us exactly what this algorithm was doing in the data.
The quants caught it clear as day in the higher row flows. Between 10:00 and 10:30 a.m. Eastern, and then again in a second wave between 12:00 and 12:45 p.m., this specific algorithm woke up and dumped roughly $3 billion of negative delta into the market.
$3 billion.
It aggressively hit the bids, initiating a massive wave of selling that drove the SPX straight down through the thinned-out order book, targeting the 99th percentile gamma strike all the way down at 6,770.
$3 billion of negative directional flow concentrated in two tiny time windows. How does an algorithm like that weaponize the specific options flows we've been discussing, especially knowing that we're hovering right near that negative gamma transition zone?
Well, algorithms of this size are fully aware of the dealer positioning landscape. They know where the vol triggers are, and they know exactly where the major put walls reside. The seek and destroy logic is predicated on weaponizing negative gamma.
Okay, so it knows the black ice is there.
Exactly. The algo knows that if it can push the index price down aggressively enough, it will force market makers who are now short gamma to instantly short the market to hedge their increasingly long delta exposure.
So the algo's initial $3 billion dump is just the spark. It's trying to ignite the dealer hedging to do the heavy lifting for it.
That's it exactly. It's initiating a cascade. The algo hits the tape hard, price drops sharply, dealers are forced to short futures to hedge. That forced dealer selling drops the price further, triggering stop losses from retail and mechanical trend followers, which forces dealers to sell even more.
Wow.
The algorithm is deliberately seeking out those massive downside put walls to trigger maximum pain, knowing the resulting volatility expansion will provide incredible momentum for its short book. It's weaponizing the higher O-delta flows against the broader market.
It's the equivalent of shouting fire in a crowded theater just to watch the stampede, knowing that the dealer liquidity are already locked.
Pretty much.
And speaking of panic, the volatility metrics on Thursday were screaming that a stampede was imminent. The VIX closed up 12% on Thursday to hit 23.76. But the notes pointed out a secondary metric that is far more concerning than the absolute level of the VIX.
The VVIX.
Yes, the VVIX, which tracks the volatility of the VIX itself. It closed at a staggering 115.93. Why is that specific 110 to 115 threshold so critical to monitor?
Because the VVIX measures the derivative of fear. The VIX measures how much investors are willing to pay for options on the S&P 500. The VVIX measures how much sophisticated players are willing to pay for options on the VIX. When VVIX crosses above that 110 level, it is a glaring siren. As the SpotGamma PM note explicitly quoted from their own historical research, a VVIX over 110 signals elevated demand for VIX options, a market that is actively hedging against a volatility spike.
It means institutions aren't just broadly worried about the market slowly grinding down. They're actively paying exorbitant, eye-watering premiums to buy call options on the VIX. They're aggressively betting that the VIX is about to violently explode upward.
It's panic buying of insurance on your insurance policy. And this connects perfectly to a behavioral observation the authors made in the AM notes earlier in the week. The VIX rarely goes from 10 straight to 30 or 40 in a single session.
It doesn't gap.
Right. It doesn't just gap up to crash levels out of nowhere. It simmers first. It builds a foundation in the high teens and low 20s. It establishes a new base camp of fear, loading up kinetic energy before it finally detonates. Thursday's price action with the seek and destroy algorithmic attacks and the VVIX exploding over 115 was the pot coming to a violent boil. The simmer phase was officially over.
Which brings us to the inevitable climax on Friday, March 6th. Breaking the box.
Yeah.
The stage was set for disaster. You have a gloomy confluence of events crashing into each other. First, it's non-farm payroll jobs report day, which introduces its own massive intraday binary volatility.
All right.
Second, you have looming weekend risk with the Middle East. Absolutely no portfolio manager wants to hold long, unhedged equity exposure over a 48-hour weekend when a kinetic war is actively expanding. And third, the ultimate macro signal, oil, officially hits that staggering $85 a barrel mark, cementing the inflationary shock.
The pressure on the structural plumbing was simply too immense. That 6,800 put wall on the SPX, which had acted as a magical trampoline for 3 solid months, absorbing every single dip since Thanksgiving, it finally snapped.
It broke.
The sheer weight of institutional selling, combined with the algorithmic momentum and the complete withdrawal of dealer liquidity in that negative gamma zone, broke the floor. The SPX officially broke out of the box to the downside, slicing straight through the support to close at 6,740, down 1.33% on the session.
And as bad as the headline SPX number looked, the carnage beneath the surface in the indices that were already trapped below their vol triggers earlier in the week was far worse.
Oh, the divergence was huge.
The divergence we noted on Tuesday played out exactly as the options math suggested it would. The QQQ completely rejected its 606 volt trigger and plummeted straight down to pin its 600 put wall. And the Russell 2000, the IWM, experienced a total structural failure. It didn't just test its put wall, it crashed right through it, dropping 2.29% to close in the abyss at 251.
We need to emphasize how critical an index breaking through its put wall actually is. The put wall is theoretically the last major line of defense where dealer hedging provides any semblance of structural support.
So what happens when you cross it?
When you break cleanly below it, as the IWM did, you are entering the absolute deepest pockets of maximum negative gamma. There is no safety net left. Every tick down forces massive dealer shorting. It's an environment where 3%, 4% daily downside moves become entirely mathematically plausible because the liquidity provision is running completely in reverse.
But the Friday PM note highlighted a crucial and frankly ominous insight regarding the volatility term structure as we closed out the week. They looked at the calendar of upcoming macro events relative to how the options market was pricing forward risk.
If we connect this to the bigger picture, the options market is a forward-looking pricing mechanism, and the term structure they mapped out was incredibly revealing. Looking ahead, the calendar was an absolute minefield.
We had major data drops coming.
You had the March 11 CPI data, the March 13 PCE and Joel test data, and the massive overarching March 18 FOMC rate decision. The term structure clearly showed massive, distinct volatility spikes already priced into those specific dates.
So volatility was elevated across the entire curve. But the quant suggested it wasn't elevated enough given the context.
Precisely. The PM note stated that despite the elevated implied volatility across the board, the spread between the forward 4 and the current term structure suggested the options market was still not fully pricing in the true jump risk.
For the newer traders listening, jump risk means the mathematical probability of a massive, discontinuous gap in price, where the market closes at one price on Friday and opens drastically lower on Monday, completely skipping all the prices in between, giving you zero chance to stop out.
Exactly. The market was efficiently pricing in the normal variance expected from scheduled economic data like CPI and FOMC, but it was struggling to fully synthesize the catastrophic tail risk of what happens when a hawkish FOMC decision collides head-on with an escalating Middle East war, an $85 oil shock, and a breaking corporate credit market simultaneously.
That's a lot of moving parts.
It is. The SpotGamma math suggested that the institutional insurance premiums, as staggeringly expensive as they were, might still be drastically underpricing a true structural washout.
Let's pivot to a deeper examination of how the actual players were navigating this minefield. Throughout the week, the SpotGamma notes flagged several specific massive block trades hitting the tape. This flow safari gives us a rare peek into exactly how the smart money, the massive institutional whales were positioning their capital amidst the chaos. I want to spend significant time unpacking these because the mechanics here are really fascinating.
Yeah, let's get into flow.
Trade 1. Gold volatility selling. The notes flag massive GLD credit call spreads being executed on both Wednesday and Thursday. For example, they highlight institutional traders selling the March 13th 485,505 call spread and the 495,510 call spread. They were collecting upwards of $16 million to $18 million in premium on these trades. Now, looking at this tape, gold is acting as a premier safe haven. It's catching a massive bid as equities fall. The trend is clearly up. Why on earth would a sophisticated fund aggressively sell upside calls on an asset that is actively breaking out?
It seems counterintuitive until you look at the volatility surface. This is a masterclass in trading implied volatility, or 5/8, rather than just directional price. As we discussed, gold was catching a strong, valid bid due to the geopolitical shock. But as the price of gold surged, retail traders and panicked macro funds rushed into the options market to buy GLD calls, desperately chasing the momentum.
FOMO.
Exactly. And this massive demand for upside calls drove the implied volatility of gold options through the roof. The options became incredibly rich.
They became completely disconnected from the actual historical volatility of the asset.
Exactly. The smart money recognized that while the price of gold might stay elevated, the fear premium built into those specific call options was mathematically unsustainable. A credit call spread involves selling a lower strike call and buying a higher strike call further out of the money to cap your risk.
Right.
By selling the 485,505 spread, they are essentially saying, yes, gold is strong, but it is not going to fundamentally alter its orbit and blow past 505 by March 13th. They are stepping in as the insurance company.
Collecting the premium.
They collect that massive $18 million premium, fully expecting the panicked IV to eventually crush back down to normal levels. Even if gold grinds slightly higher, as long as it doesn't explode past their short strikes, the collapse in implied volatility will make those spreads highly profitable. They are fading the panic, not fading the asset.
That is brilliant. Okay, trade 2. VIX upside bets. This one's on the opposite end of the spectrum. On Wednesday, right around 11:00 a.m. Eastern, the Cape absolutely lit up. An institution came in and bought an 80,000 lot of VIX July 60 calls, alongside 20,000 lots of July 26 calls. They spent over $12 million in premium in a single sweeping execution. Let's talk about the strikes here. A strike of 60 on the VIX is astronomical. We've been discussing the VIX moving from 15 to 23. What does a 60 print actually imply about institutional expectations?
You don't buy 80,000 VIX 60 calls to hedge a 5% pullback. A VIX of 60 is not a normal market correction.
No.
A VIX of 60 is a systemic history book event. You only see prints like that during true black swans. The global pandemic lockdowns of 2020 or the absolute depths of the 2008 global financial crisis. For an institution to drop $12 million on a strike that incredibly far out of the money, expiring all the way out in July, communicates a very specific thesis.
They aren't just hedging the March FOMC meeting.
No. They are looking completely past the immediate term structure. They are preparing for the very real probability that this geopolitical conflict, combined with the underlying credit stress we saw in the BIZD ETF, doesn't just resolve in a few weeks. They are betting that these factors could spiral into a multi-month systemic liquidity crisis that forces widespread deleveraging.
A true tail risk hedge.
It's a pure tail risk hedge. If the VIX hits 60, the equity portion of their portfolio is likely down 20 to 30%. That $12 million options bet is designed to explode in value and offset hundreds of millions in equity losses. It's a terrifying print to see hit the tape, frankly.
Trade 3 highlights a fascinating divergence in how different sectors were being treated. We see tech and crypto positioning moving in opposite directions. On one hand, the notes flag 13,000 contracts of NVIDIA, NVDA, March 1950-200 call spreads being bought. This was clearly an institution playing the upside catalyst of NVIDIA's massive GTC conference, scheduled for mid-March. But on the exact same day, they highlight 78,000 contracts of May 6 puts being aggressively bought for over $4.2 million. M8A is a massive crypto miner, and this was a direct bet on heavy crypto weakness as Bitcoin was already starting to fade back to 68K. How do we reconcile this?
It perfectly illustrates how sophisticated funds compartmentalize risk. Even in a violently unstable negative gamma market, institutions will still hunt for isolated, idiosyncratic catalysts. NVIDIA's AI conference is arguably the single most important fundamental event for the tech sector. The fund buying those call spreads believes that NVIDIA's fundamental news can temporarily override the broader macro fear, at least enough for a short-term trade.
But the MARA put buying is the dark side of that coin.
Exactly. Bitcoin and crypto proxies like MARA are ultra-high beta risk assets. They are essentially pure liquidity proxies. When macro liquidity drains and the US dollar strengthens violently like we saw on Tuesday, the smartest players instantly attack the most speculative fringes of the market.
Right.
They aggressively shorted the crypto proxy because they knew it lacked fundamental earnings support and would lead the absolute fastest in a flight to safety environment. It's surgical targeting of the weakest links in the chain.
And that surgical targeting leads perfectly into Trade 4, idiosyncratic risk in airlines and emerging markets. The Friday AM note specifically flagged that airline stocks, most notably Delta, DAL, were dropping over 4% on heavy volume, with massive put skew. Simultaneously, they highlighted EM, the massive emerging markets and Asia ETF, seeing its implied volatility spike sharply. How do these localized fires connect back to the broader macro picture we started with?
They connect directly to that $85 crude oil print. This is the options market efficiently pricing in the secondary and tertiary effects of the macro shock. Higher oil means jet fuel costs absolutely decimate airline operating margins.
That's the travel fears.
Furthermore, a broadening geopolitical conflict immediately implies severe potential disruptions to global travel. The math for the airlines changes overnight. Meanwhile, the emerging markets in Asia are heavily, disproportionately dependent on imported energy and the stability of global trade routes.
So they get hit twice.
Right. When institutions see an energy shock of this magnitude, they don't just short the S&P 500 blindly. They immediately start buying aggressive downside protection on the specific sectors whose business models are most exposed to that singular input cost. It shows a highly sophisticated market pivoting from broad index hedging to surgical, sector-specific destruction.
Wow. We've covered a tremendous amount of incredibly dense ground today, from the dealer mechanics of the Thanksgiving box, to the soaring conflict premium in oil, to the IRO flows exposing fake rallies, algorithmic seek and destroy attacks, and ultimately the complete structural failure of the 6,800 put wall floor. So what does this all mean? Synthesizing all of this quantitative data, what is the ultimate takeaway for a TSS trader trying to navigate the tape next week?
The single most important takeaway is that the fundamental market regime has inverted. For the last 3 months, we operated in a stable, positive gamma regime where the overarching, mathematically correct strategy was buy the dip. The dealer mechanics naturally suppressed volatility and rewarded mean reversion.
The shock absorbers were working.
They were. But this week, driven by the dual shocks of geopolitical escalation and lurking credit stress, we forcefully transition into a highly unstable negative gamma regime. In this new environment, the dealer mechanics actively amplify volatility. The entire rulebook flips. Rallies are no longer organic signs of strength. They are mechanical, short-covering mirages driven by put monetization that must be heavily distrusted or aggressively sold.
The new regime is sell the rip.
Sell the rip. Until the geopolitical vol premium actually bleeds out of the market, until crude oil breaks its fever, and that VVIX firmly retreats below 110, traders must operate with the understanding that the floor is incredibly slippery, the ceiling is hard, and predatory algorithms are actively hunting for liquidity voids.
You have to adapt your strategy to the math, or you will get run over by it. Which brings me to a final thought for you, our listener, to seriously ponder as you review your positioning this weekend. The SpotGamma sources noted localized panic appearing in very specific, distinct areas of the market. We saw the airlines getting hammered due to the direct impact of oil. We saw emerging markets experiencing severe volatility spikes. And perhaps most importantly, we saw that fascinating, terrifying plunge in the BIZD Business Development Company ETF, hinting at deep, silent stress in the corporate credit and middle market lending space.
Yeah, that credit stress is the wild card.
It is. Now, throughout the chaos of this week, the broader market seemed to be relying on the 6,600 SPX level as the ultimate theoretical washout safety net, the final line in the sand where dealer positioning might stabilize. But looking at the convergence of these specific data points, we have to ask a much darker question. What happens if those localized, idiosyncratic risks specifically, a sudden silent freeze in the middle market credit space, suddenly merge with the loud geopolitical oil shock? What happens if the bond market completely seizes up exactly at the moment when the broader equity market is already completely submerged in maximum negative gamma?
That's the jump risk we were talking about.
Exactly. If the dealer shock absorbers are entirely gone, the algorithms are aggressively selling delta, and multiple systemic crises collide at once. Could that theoretical 6,600 floor simply vanish? Could the liquidity void extend far deeper than the options term structure is currently pricing? It is a terrifying scenario, but based on the math we unpacked today, it is no longer an impossible one. Keep your risk incredibly tight, respect the absolute danger of a negative gamma environment, and stay exceptionally nimble in the week ahead. Thank you for joining us on this deep dive.